Warren Buffett just made a huge move, and it's raising eyebrows across the investing world. Berkshire Hathaway has completely dumped the S&P 500, hoarding an enormous pile of cash instead. What does this mean for the stock market? Should you start selling? Is Buffett predicting a crash? Before you make any decisions, you need to understand what's really happening behind the scenes, because this isn't just about selling stocks. Buffett is playing chess, while most investors are playing checkers. And here's the most important part. His strategy might be your biggest opportunity if you know what to do next. In this video, I'm breaking down exactly why Buffett is making these moves, what they could mean for the future of the market, and, most importantly, what you should be doing as an investor right now. By the end of this video, you'll have a clear game plan, whether you should hold, buy, or rethink your strategy. Trust me, you don't want to miss this. Let's get into it. A recent post from Warren Buffett's stock tracker caught my attention. Berkshire Hathaway has fully pulled out of SPY and VOO. In other words, they've completely dumped the S&P 500, and that's something worth noting. Even more intriguing, they've poured a significant amount into Domino's Pizza. Now, we can debate pizza all day, but let's be honest, this decision isn't about taste, it's about strategy. Let's go deeper into what's happening, because Buffett is also paring down his financial sector investments, offloading bank stocks left and right. If someone like him is making this shift, it raises concerns about what's ahead for the financial industry. After extensive research, here's what stands out. During previous market downturns, the dot-com collapse of the early 2000s and the 2008 economic meltdown, Buffett stayed on the sidelines, while others rushed into overhyped stocks. He didn't get caught up in market frenzy. Instead, he held on to capital and selectively invested in stable, revenue-generating businesses at reasonable prices. And when markets eventually crumbled, his portfolio didn't suffer the extreme losses that wiped out so many others. Even better, he had a mountain of cash ready to deploy at bargain prices when panic set in. As the Globe and Mail put it, Buffett had always championed holding substantial cash reserves as a key advantage. It's not just about keeping funds idle, it's a calculated play. Cash serves two powerful purposes: protection. It acts as a shield, allowing investors to weather financial storms without having to sell off assets at the worst possible times. Opportunity. It provides the firepower to make bold moves when the market presents rare chances. Buffett isn't stashing away cash for no reason, he's positioning himself for the perfect moment. The real question is, are we paying close enough attention? Cash provides an unmatched level of flexibility when needed most. It allows Buffett to capitalize on unexpected opportunities that require quick action, especially during economic downturns or when undervalued assets suddenly become available. His ability to acquire major stakes or even entire companies at fair prices without relying on outside funding comes from this financial agility. By maintaining liquidity, Buffett ensures that Berkshire Hathaway can always make moves that over-leveraged or cash-strapped investors simply can't. This approach highlights a key part of his strategy. Cash isn't just something to sit on, it's a weapon to exploit inefficiencies in the market. Having large amounts of available cash means being able to act swiftly, making strategic investments while other companies scramble to free up capital or secure financing just to compete. Warren Buffett is the ultimate example of patience, a rare and difficult skill to master. Buffett himself has repeatedly advised regular investors to take a different approach. Imagine this scenario. You're 30 years old, sitting on your first million, with enough savings to cover your living expenses for the next 18 months and no dependents. Buffett's response to that situation? Simple. He'd put the money into a low-cost index fund, likely something from Vanguard or another well-established low-fee provider. Why? Because unless you plan to become a full-time investor, it makes more sense to acknowledge that reality and stick to a simple, proven strategy. Unless you're investing at the peak of a massive bull market, which this isn't, index funds tend to outperform bonds over the long run. The smartest move? Invest. Let time do its work and get back to focusing on what you do best. The truth is, most investors won't achieve legendary status. There just aren't many wildly successful professional investors out there. Buffett himself recognizes that, And that's why his advice has always been clear. For most people, long-term investing beats trying to time the market. The financial world is packed with so-called professionals, constantly taking their cut while claiming to be expert investors. That's just the reality of the industry. But if you don't have a reasonable chance of becoming a highly skilled investment expert, Buffett's advice is straightforward. Opt for something simple, like an index fund. Right here, he's making it clear. Pick an ETF or index fund with minimal fees that mirrors a broad market benchmark, such as the S&P 500 or the total US stock market. The bottom line, most people won't thrive by trying to time the market the way Buffett does. And the reason is simple. You're not Buffett. Unless you're a seasoned market professional, and even then, it's unlikely you'll consistently outperform the S&P 500, just as Buffett himself has explained. But here's the tricky part. No one earns money by telling you to invest in index funds. That's why so many advisors and fund managers will try to convince you that they can deliver better returns. Through management fees, commissions, or complex financial strategies, they promise to beat the market, but in reality, they rarely do. If 1,000 investors just like you followed these so-called expert strategies, the vast majority would actually underperform compared to those who simply stuck with a low-cost index fund. Now ask yourself, why expect anything more? Over a 30 to 40-year period, a well-diversified index fund has historically provided steady and solid returns. But financial salespeople will always insist they can do better. The statistics speak for themselves. Most people would be better off keeping their investments simple. Now back to what I mentioned earlier. Warren Buffett recently made some big moves within Berkshire Hathaway's portfolio. Over the last quarter, his firm reduced its holdings in Bank of America, scaled back to 680.2 million shares, worth $29.9 billion, from 797.7 million shares. NU Holdings dropped to 40.2 million shares from 56.4 million. Citigroup cut down to 14.6 million shares from 55.2 million. Capital One Financial lowered to 7.45 million shares from 9.10 million. At the same time, Berkshire increased its stake in SiriusXM, jumped from 116.1 million shares from 105.2 million. Occidental Petroleum expanded to 264.2 million shares. Domino's Pizza nearly doubled its position to 2.38 million shares from 1.28 million. Meanwhile, Buffett kept his largest investments unchanged. Apple, holding firm at 300 million shares, valued at $75.1 billion at quarter's end. American Express, remaining steady with 151.6 million shares and valued at approximately $45 billion. Now, about Berkshire Hathaway's decision to completely exit the S&P 500. What's surprising is that they've even held S&P 500 investments in the first place. Buffett's approach has always been to seek undervalued companies, particularly those trading below their intrinsic value, allowing room for significant long-term expansion. But how much did they actually have in that portfolio? Let's break it down. The total value of SPY and VOO combined in Berkshire Hathaway's holdings, just $48 million. Given that the company's entire portfolio is valued at around $270 billion, this means their S&P 500 exposure made up roughly 0.01% of their total investments. To put that in perspective, imagine you own a $100,000 investment portfolio and you decide to sell off a stock worth $10. Would that dramatically shift your financial strategy? Not at all. In reality, Berkshire's position in the S&P 500 was never a substantial portion of their assets. So, should we take Buffett's decision to exit the S&P 500 as a signal for us to do the same? Absolutely not. If you review Buffett's past remarks regarding the S&P 500 and the average investor, his stance has remained unchanged and straightforward. Stay invested for the long haul. Time and again, Buffett has emphasized that the best move for most investors is to allocate around 90% of their portfolio into a broad, low-cost index fund, like one tracking the S&P 500 or the total US stock market. What's truly noteworthy, though, is that Buffett isn't aggressively buying new assets at the moment. The fact that he's sitting on enormous cash reserves suggests he sees many stocks as overpriced and is waiting for the right opportunities to strike. But as for me, I'm sticking to the approach Buffett has long endorsed, investing in a low-cost index fund that mirrors the overall market, whether it's the S&P 500 or the total US stock market. So what's the big takeaway from all of this? Warren Buffett isn't just sitting on cash for no reason. He's waiting for the right moment to strike. History shows that when Buffett holds back, it's not out of fear. It's because he knows something others don't. Does this mean you should sell everything and follow his lead? No. For everyday investors like you and me, Buffett has given the same advice for decades. Stick with a low-cost index fund. Stay invested for the long term. Ignore the noise and avoid market timing. What he's doing with billions of dollars is not the same as what most investors should be doing, and he's made that clear. But one thing is for sure, he sees something coming. And if the greatest investor of all time is preparing, maybe we should at least pay attention. So now, I would like to hear from you. Drop a comment below. Do you think Buffett is predicting a market crash, or is he just waiting for a golden opportunity? This video is for educational and informational purposes only and should not be considered financial advice. I am not a financial advisor, so always do your own research and consult a professional before making any investment decisions. If you found this valuable, tap that like button, subscribe, and I'll see you in the next video. Your journey to financial freedom continues, and I'm excited to be part of it. Here's to your investing success. Profitable investing.